Hello and welcome. So it is exam season for aspiring financial modelers. So today I'm going to be doing a video on a question from the FMWC, actually the very first question from the Financial Modeling World Cup, which was geared as a warm-up for the AFM. So I'll put the link down in the comments to where you can get the original file, but I've got right here the case description with a bunch of details that I'll talk you through as we get to them, and then the Excel file, which has all the numerical assumptions in here and has the historical financials here. So I'll just caveat up front by saying anything I say about the AFM exam is based on my experience of having done it, which was many, many years ago. So it's possible it's all changed since then, but I can't imagine it's changed too much, at least in the basics. So, pretty typical sort of AFM style case. Here's your historical financials and then all the assumptions here and in here that you need to project it forward for some number of years. And just a kind of quick bit of context for the FMWC question. This was like one of 3 questions in 2 hours, so much shorter time frame than you get for the FMI, but the expectation was also much lower. So for that one, I think we were asked to prepare kind of certain schedules and come up with particular answers, but you didn't actually have to build the full 3-statement model. But since this is more geared at sort of help for people who are getting ready for the FMI, I am going to try to build the full 3-statement model. I'm not sure I'll get it all done in one video because, I think you get 3 or 4 hours or something like that for the FMI exam. So, this one's probably not quite as big as complicated as that, but it's not a million miles away either. So a couple of other upfront comments and then we'll kind of dive into the details. So one thing is just this versus the FMI, like versus a full FMI exam. I think this is probably a little simpler. There's probably a little bit less to it, but again, not a million miles away. One thing that is an important difference is this is a little bit more prescriptive. So, for any competition question, there can only be one right answer, and so all the assumptions are completely laid out. In the AFM, at least when I did it, it was often the case that the biggest assumptions would be stipulated, and then other assumptions, for example, your working capital days, you might just be asked to make reasonable assumptions, and so you might have to work out what was the ratio in the past, and then plug something in. Maybe it stays the same, maybe it gets a little better, maybe it gets a little worse, but make a reasonable assumption. Obviously, in the FMWC context, you never make your own assumptions because then the answer will depend on the assumptions, and then not everybody gets the same answer, which if you have examiners who are taking time to review every model and assess how it's built and so on, as you do in the FMI exams, then that's fine. If you need to check whether people got a multiple choice question right or wrong, then it doesn't really work. So that's a bit of a difference. The other one is this one. The assumptions here don't explicitly include any scenarios, which again I think the AFM typically does ask you to have a base upside downside or some variant on that. So that's a little bit of a difference as well. Anyway, so let's dive into it. So yeah, we've got our 3 statements. So income statement here, cash flow statement here, and balance sheet here. I'm going to do a couple of things on setup first. First one is just purely a matter of taste, but I would rather have each of these on a separate tab. So I'm going to have my income statement, my cash flow, and my balance sheet on separate tabs just for ease of access and moving around. So let me just come down here and go down to the end and kill that. So I've made 3 copies of the tab, so I'm just going to remove the right pieces from each one. Oh, that's linked back up to the top. Oops, okay, fine. So do it here then. And there. And those are also linked back. Fine. I'll just put it here. And kill the balance sheet. And then for the balance sheet, again, keep the name because that links back. And then I'll link these back up to here. So now I've got my three statements on different sheets. Now, the next thing, the first kind of substantive thing in terms of setup, is a little counterintuitive, but actually it's probably the single best tip I have to offer if you're preparing for this exam, which is, you might think, okay, well, I've got, assumptions on sales, assumptions on operating costs, assumption on Capex and depreciation. Let me work through each of those, prepare all my schedules, and then start putting an integrated model together. My suggestion is to do the exact opposite of that, which is to say, start by building out the model in a very, very simple way, as I'll show you in a second, and then like fill in real numbers. So in other words, the most simplistic possible projection that you can have is that there will be, no income, no sales, no anything, no activity for 5 years. In that case, all the items on your income statement will be zero, all the items in your cash flow statement will be zero, and everything on your balance sheet will stay the same. And in a few minutes, you can kind of build out the model to do that. And then if you set your plumbing up, so these ones are actually given here. I don't know if that's normal for the FMI or not, but if they're not, you can kind of add in your formulas here. But once you have it linked up so that these are the bits that are assumptions, these ones are calculated, then let's say I start creating some activity. I put in some revenue here, and that flows down into net income, and it flows through into cash flow, and it flows through into my balance sheet. Then the whole idea is, as long as I have all the plumbing set up, every single step I make, like when I add in my revenues, when I add in my costs, when I change my working capital and so on, at every step along the way, I should continue to have a balance sheet that's balancing. Because in a world where, we have revenue but no costs, your balance sheet still balances. In a world where we buy new things, but there's no depreciation, the balance sheet should still balance. Basically, if you just imagine it as, you're gradually adding in all the transactions that make up the business's operations for a year or for each of the several years, every kind of debit and credit that you put into the underlying ledgers, you should have 3 financial statements that make sense if those were the only transactions the company did. And so we're just going to add in the transactions a little bit at a time. So enough preamble, let me sort of show you what that looks like. So the first thing I'm going to do is just copy everything across. So I'll scroll down all the way to the bottom. We're looking for a 5-year model, so 1, 2, 3, 4, 5. I'll copy that across. I'm going to, I'll leave that in for now. So obviously the number format is set up here such that you've got the letter A for actual. So I'm just going to change this to, I guess, E for estimate, or whatever your preference is. And then all these blues, I'm going to, so I'll just make black, because that's a typical color for a calculation. And actually, since everything is going to be black down here, I can just go all the way down. I'm also going to turn off grid lines because those kind of bother me. And I guess I will lock my view so that I can scroll around without losing things. I don't know if these are used. No dependence there, no dependence there. All right, so I'm actually just going to, well, I won't delete them just in case, but I'll hide them. Actually, let's DGG, group them just in case. Slightly better practice if you're going to hide something to group it so that someone can have the plus button there to unhide it. And then let me also see how we're doing on space here. We've got some empty columns, that's fine. I'm just going to tighten this up a little bit so it's not quite so much empty space. All right, so now the first thing I'm going to do is make all my net revenue 0, and I'm going to make that yellow. And then I'm going to put that there, and there, and there, and there, and there. So in other words, everything is nicely zeroed out. And then I'm going to make them all yellow. So let me just, I want everything that is not a calculation to be made yellow. So I'm going to go to constants, hit enter, and then each to get color. Okay, so that's that. Now I want to do the same thing on my cash flow statement. So again, come down here, 1, 2, 3, 4, 5 years, copy across, I turn off grid lines. I'm going to freeze panes so that I can always see my headers. I will just take the formatting from here. Oh, did I only go 4 years? I did. Whoops. So let's make that 5, please. Control R to copy across. And now, so important thing, is this first line. So like I said, you assume no activity, but the net income should come from over here. So I'm just going to link that back to there, press enter, and then everything else I'm going to make black, yellow fill, and 0. And then I'll copy that down. And then set. I don't know why this is not a formula, but let's make it a formula. So, oops, sorry. So this one is a formula, that one is a formula, that one is a formula. Good. So then this should just be the sum of that, that, and that. And then it's a good idea to just, so 81.7, if I copy that back, that works. 76.28, that works. 92.3, that works. So if you're adding in, so, you know, in this one they're being semi-generous because most of the formulas, you know, just adding up here, or, you know, your formula calculating your EBITDA, kind of combining all of these together, are already filled in. This one is not, but a good check is to just copy it back to the historical data and make sure that it checks out, and that's good, it does. Then beginning cash, obviously we're going to want to link that to the balance sheet. So the beginning cash for 20 is the closing cash for 2019, which is right here. And again, if I copy that back, 180.29, that checks out, so that's good. Then I'll copy that across. Obviously this isn't working right now because I haven't filled out the balance sheet, but I will in a minute. So this is all calculations down here, so I'm going to make that black. Oh, and I've lost my top line here, so let me just put that back. HBP, I think, for top. Yes. Okay. And then finally, we'll carry over the balance sheet. I'll get rid of grid lines here again. Did I do that here? I did. I will freeze my columns here again. And then go down to the end. And cover across 1, 2, 3, 4, 5. And we'll take the format here again. And then here, the equivalent. So take my ending cash there, copy that across, make that black because it's a calculation, and then the equivalent here to everything being 0 on the, so the income statement and cash flow are flows, they're what changed over the year. The equivalent on the balance sheet to no change is not 0, but everything's staying the same. So I'm going to put in that formula pointed to the previous year, and again I'll make that black, and I'll make it yellow to remind myself that, so basically as we're going through, you know, at some point I will put in the correct formula for accounts receivable. At some later point I'll put in prepaid expenses, inventory, etc., etc., etc. But for now I'm just making it yellow to remind myself that that is not done. And I've lost that again. So let's do this. Revolver, accounts payable, this debt, this debt, this debt. Preferred shares, common shares, retained earnings. And I'll fix retained earnings in a second. Don't worry, I haven't forgotten about that. So retained earnings, we're going to want, well, for now I'm just going to say previous retained earnings plus net income. We'll need to adjust that for dividends later, but right now we've zeroed out all the dividends, so that's fine. So no fill there. We might need to come back and adjust it later, but for now it's fine. So, and then the important thing is I'm going to have my balance sheet check. I'm just going to say round. Total assets minus total liabilities. Oh, sorry, I've got a total liabilities and equities line there. Good. Sorry, round that to, let's say, 6 decimal places. And the reason I round it to 6 decimal places rather than leaving exactly 0 is because visually, if we use a number format like, let's say, 0.00 minus 0.00, and then a dash format for 0, then visually we'll see a different thing for 0, and 0 is, you know, the check passes. You know, some people prefer to like use conditional formatting to make it light up red or something like that. For a check like this, I just like to have it as simple as possible, but then the important thing is I'm going to, actually, sorry, not sum, but rather sum square. Sum square means that if some of them are negative and some of them are positive, but they cancel each other out, we'll still get a positive number here. So yeah, basically if you have like Excel rounding errors where there's a difference of, you know, 10 to the minus 12 or something like that, then you want that to appear as 0. And now what I'm going to do is I'm going to give this a named range, so I'll call it BS check. And then I'm going to make a very aggressive conditional formatting right here. I'm going to use formula equals BS check greater than 0, format fill red. And so this is going to help me to check at each stage as I go along. 10, 6. That I am, got inconsistent numbers of empty rows here, so let's just tidy that up a little. So now my years are all in the same rows, that's good. So let's just give a quick demo. You'll see it obviously as I go through kind of building the actual things, but let's say I just delete this for a minute. Now what you'll see is every sheet is going to turn red. So if, as I make changes and I go through and I add things, I break the balance sheet, if I've just done one half and I'm about to add the other half, then fine. I'll know, okay, it's red, but it's going to turn white again in a second. But if I've added something and I think I'm done, then no matter where I am in the spreadsheet, I will see, the world has turned red, and that's a problem. And so, rather than your balance sheet being kind of one huge check at the end of, all the 100 different things that you've modeled, have they all checked out? If your balance sheet balances, then it's like, hooray, everything works, maybe. But, if you've got complicated things like, I don't know, if you've got, deferred tax assets and liabilities and whatever, I don't know, maybe you're an accounting wizard, but if you're at the level of doing an AFM exam, then you will probably find this method where you get to check piece by piece, and it's a very, very easy check. If something's not balanced after the last thing you added, then that's exactly where the error is coming from. Then it's very easy to make sure. It won't guarantee that you don't make mistakes, because a balance sheet will still balance if you have the wrong revenues, and a balance sheet will still balance if you have the wrong costs and if you have the wrong depreciation methodology and so on. But it will mean that you can be fairly confident that you're putting everything in with the right sign, that it's hitting the balance sheet in the right way. So it's a good check to have set up right from the start. And I don't know, I've probably spent like 10 minutes or so setting that up. In the context of 3 or 4 hours that you have for the AFM exam, I consider that time extremely well spent. So anyway, having said all that, let's get on with some actual modeling. Well, that was modeling, but let's get on with turning some of these from 0 into not 0. So let's start with sales. So in 2019, the average number of stores was 3250, and that is right here. By the end of the year, it's growing to 3,300, and that is right here. And they have a capacity constraint of 3,500, which is in here somewhere. Net sales per store expected to grow at 3% every year. They open 100 new stores a year, gradually through the year. And then a little bit of advertising for CFO templates, because they're one of the sponsors of the FMWC. But the upshot is they're expected to close 25 stores a year, and that also happens gradually through the year. So 100 stores added, 25 stores removed, net growth of 75 per year, and they have a capacity constraint of 3,500 stores. And when that is reached, they'll keep closing unprofitable stores and replacing them one for one, but they'll only replace the closed stores. So this is definitely something we're going to want a schedule for. So let's do, well, I don't know how many schedules I'm going to end up with. If I have a lot, I might want them on separate tabs, but for now I'm just going to have one schedule tab, and let's just copy some of the formatting from here. Please copy the column widths, and we'll copy, oh, I thought this was linked. Funny, there is an assumption on the home page, but this is apparently not linked to that. So let's link it to that just for good measure, and carry that over and do it here, and do it here, and then let's take all of this, that there. So we'll call this supporting schedules, and I guess really I should make all of this go out here as well on all of these, so that everything is nicely centered across the whole range. By the way, if you're doing the AFM, then like a legitimate part of the exam is making your model presentable. I'm going to do a certain amount of formatting as I go, just because, I find it ugly when I notice that this line isn't going out far enough and other things like that. But I'm not going to do, I'm certainly not going to do everything. Probably I will make it a separate video to spend a little bit of time on what kind of beautification you might do after the model is working. But for today, I think I will settle for a working model if I can get that. So, having said that, so let's just do revenue schedule. So let's do opening stores. Whoops. Actually, sorry. Let's do stores. Opening, added, closed, closing, and then average. So what are we told? We're told the 2019 average. Sorry, I'm just going to move this tab over next to the assumptions. I don't know if other people do this. I move tabs around a lot when I'm building, just so that, I can be one tab flip away. So this one is this. No, average number of stores is 3250. And the opening number of stores, which is, let's put it here. And for both of these, I'm going to, you may have or prefer to have a kind of specific format that's for like links to the assumptions tab. In this case, I'm just thinking of it as I want to highlight this is a different formula from the rest of the rows. So in other words, for the rest of here, my opening is going to be pointing at my closing. My opening is going to be pointing at my previous period's closing. And my average is going to be pointing at my opening and closing. I'll comment a little bit on this formula in a minute, but let me just fill in some things first. So every year we're going to close 25 stores, which is in a cell here somewhere, I assume. Oh, yes, here it is. And we've got a separate one for each year, even though it's the same assumptions. That's fine. I'll just carry that across. Now, what we need to be careful with is limiting the number of stores we add so that we don't end up over capacity. So first, let's just do it naively. Add 100 stores. And now we can see, in 2022, we get above our capacity limit of 3,500. So, simplest way to do this, well, first of all, let's capacity limit. Let's put that in. That is over here. And we'll lock that in so that I can use the same formula all the way across. And then, so let's say equals min of, equals min of, so it's either that or it's limited by this number minus this number minus this number, I think. Let's carry that across and see if it works. Yes. Okay. So in other words, in this year, we add 75 stores, net add 50 stores, go from 3450 to 3500. Oops, keep my number formatting consistent there, so that's just Alt-EST to paste formats. Okay, and then I've got my average here. Now, one quick thing, when I don't know, maybe this is a case of me overthinking, or maybe it's a matter of taste, or maybe it's an example of me being a wise and excellent financial modeler. But I spent quite a while when I actually did this question in the FMWC, agonizing over the correct way to calculate the average in the year where you hit the capacity constraint. And it turned out this average of opening and closing was, I was able to kind of check against the answers they were looking for, and this was the way they wanted it calculated. But actually, on a straight reading of the description, if you say, well, you're adding stores at a rate of 100 and closing stores at a rate of 25, so like net adding at a rate of 75 until you hit the capacity constraint. Well, I would say if you've got 50 stores to add, then over the first 8 months of the year, you would add net 50 stores, and then you would remain at 3,500 for the rest of the year. So actually your average number of stores open would be more than this, because you'd spend 8 months of the year going from 3,450 to 3,500, and then you'd spend the rest of the year on 3,500. So, it's, let me see, where's my draw doodle, what's it called? I don't remember. Ink equation, draw pictures, maybe? No, never mind. All right, there's a draw thing somewhere. I've just forgotten what it's called, so I can't pull it up. But anyway, it's the difference between something that goes up in a straight line and something that goes up more sharply and then levels off. So if you wanted, I'll just call it picky average. If you wanted to calculate it that way, then you would, here's one way you could do it. You could say if this is equal to is equal to the constraint, or let's just start with a simple case. If this is less than the constraint, then it's just going to be, well, you could either point to the other one or you could recalculate. It's the average of the opening and the closing. Then if it's equal to, so if you get to the constraint at the end, then it is basically how much of the year does it take you at a net growth of 75 to get from there to there. It's that much of the year at that average. So let's see, we can call it the constraint minus your opening stores. So in other words, the number of stores you have to add to get to the constraint, divided by the rate at which you're adding stores. And I'll actually link that back to here minus here. And the reason I'm not linking it up to here is because this is the one that will be limited. So in our limiting period, that'll be 75 rather than 100. So in other words, you know, when we get to here, we've got 50 stores to go to get to the limit. We're adding at a rate of 75. So in 2/3 of the year, you would get there. And actually, I'm just going to, because I'll have to reference that again, I'm going to say let, what should I call it? Grow period. In other words, or grow percent. How much of the year are you growing for? The answer is that much. Then my actual answer is my grow percent times the average of the opening and the closing. Sorry, you've got to get rid of that, plus the rest of the year, 1 minus growth percent at the full capacity. And then close brackets. So 3338, so that matches that. You end up with a slightly higher number here, and it matches the rest of the way along. So yeah, like I said, I honestly don't know if that was me just being too picky. Again, it's the kind of thing where in the FMWC it matters a lot because you know it'll decide whether you get the answer right or not. In the FMI, as long as you're doing something reasonable, you know, even if you get that exact calculation wrong, it's kind of fine. So anyway, that's a little bit of a detour. So we figured out our average number of stores per year, which is the thing we were ultimately aiming to get. I'm going to set aside the picky average and assume we're just working with the normal average. Then we're going to want sales per store. And so first we want to figure out what it started off as in 2019. So I'm going to take my net revenue for 2019 divided by my average number of stores in 2019. And again, whenever you navigate off a sheet and then back onto it and then click on something here, it adds the sheet name to it. I won't go into the whole 9 yards about why you don't want it, but this formula, when you copy it and sort it and do other things with it, will not behave exactly the same way if you have the sheet name in front of it as it will if you don't. So I always get rid of that sheet name. So my average sales per store is this, and then I'm given a growth rate. Where is it? Yes, grow by 3% every year, which should be over here somewhere. Wait, here we are. Sales per store growth rate. So again, there's 5 different assumption cells, even though it's the same assumption every year. So that times 1 plus, or actually, you know, it's sales per store growth. It's just, it doesn't make any difference from an Excel perspective, but from a human readability perspective, it's a good idea to just have that there, and I'll just italicize it as a style point. So that times 1 plus that, carry it across, and then trying to make it a little bit more of an effort to say when I'm using a keyboard shortcut, although I find it really hard because I don't think much about using them, but that's Control-Shift-1 to get common number format with 2 decimal places. So that's my sales per store and how that grows, and then so my net revenue, thank you, is going to be my average number of stores times my sales per store. And again, this time this time I do, so let me just go back. I do Control Shift 1 to get number format of 2 decimal places, and then Alt H9 twice to get rid of the decimal places. Or I could just come up here, copy because I have something that's in the right format, and then come down here and Alt EST to paste the format. And now that I have that, let me put that in here and carry it across. And I'm going to number format this as well. Sorry, this does have 2 decimal places, just keep it that way. And now let's see, this is feeding down into my net income, that's good. My net income is feeding into my operating cash flow, that's good. So I'm growing my cash all the while, and that's good. So my cash is going up, my total assets is going up, and then it's all feeding into retained earnings, which means that my equity is going up. So that's obviously not where things are going to end up, but that is a perfectly reasonable outcome for now, and that's why nothing turned red. So that's my first schedule done. Hooray, revenue schedule. Let's think about what's next. Operating costs. So let's just first of all look at the income statement. What have we got? We've got just cost of sales and SG&A. And then we've got a line for cost adjustments, gain or loss. So cost of sales, this is about cost of sales, this is about cost of sales, and then we've got a simple assumption for SG&A. So cost of sales is at least a little bit complicated, so let's have a operating cost schedule. And then what do we want? We want to have, let's say, cost of sales, let's say fixed, variable, total. And so I'll start off with my total cost of sales from 2019. Sorry, actually I should lock in my view here as well. Sorry, no, don't need revenue schedule to always be on top. That's Alt WF, by the way, to freeze panes. It just means that when you scroll down or across, you can always see these rows on top and these columns on the left. So that's a little better. Again, I'll want to format that, so copy this down. And then I'm just going to link in here. So I've got fixed costs of 15% and variable costs, so I can just copy that formula down because it was in the next row, or 85%. And I would usually just make that sort of gray as my way of showing that's just a reference cell. And then I'm going to multiply this by this. Oops. Okay, so now let's have a quick look. So fixed costs grow by 2% a year for the next 5 years, which I assume is over here somewhere. Inflation rate, probably just that, unless there's a separate, no, it's in line with inflation. Fine, so then my fixed costs will be that times 1 plus inflation rate, carry it across, format, and then, sorry, I should just format all of these in the first column. Should be colored differently because they're a different formula. So my setup formula versus my 5 years of projection are going to be different formulas. And then variable as percent of sales. Well, fine, I can just reference them on the other sheet. So I was looking up here because I thought I might have net revenue there, but I only have it for the projection period. Yeah, I'm fine with that. So cost of sale now as a percent of net revenue. Oops, all right. So again, Control Shift 5 or Control % sign changes that into a percentage. And then again, that's a different formula. So Alt HFC font color, make it red. And then the assumption we're told is that stays the same the rest of the way across. So then my variable costs will be my net revenue times that percentage. And again, we'll format that, carry across, sum it up, carry across, and then here just put in a line above HBP. Alt HB is borders, and then P is top, O is bottom, D is top and bottom, I think. I don't know, I don't remember them all. Anyway, okay, so that's that, and then SG&A doesn't really need its own schedule because it's just is what it is, but SG&A and SG&A growth, since we have an operating cost schedule anyway, I will put it in here. So we're told an assumption for 2020, which is down here, up here, I don't know where it is. Oh, here it is, SG&A in millions for 2020. And again, I'll make that red because it is a unique formula in the row. And then everything else is going to be, I think it just said in line with inflation as well. Yeah, well, it actually just says grow by 2% thereafter, but since there is only, this is the interest rate, so that's obviously not the one, so we must be meant to use the same one for that as well. So that's what I'm going to do. So come back over here. So this times 1 plus 2, sorry, no, in 2021 we grow by 2%. And carry that across. And again, copy that format. Sorry, that's actually, no, I think I want with 2 decimal places there because that's coming in here where it will have 2 decimal places. Okay. Now I notice this one also is not formatted the way I want it to be, so I'm going to make all of this percent with 2 decimal places. So now my cost of sales is this. Carry that across. And my SG&A is this, and I carry that across. And just a quick sense check, one of the reasons, there's no 17 or 18 in my supporting schedules, and I would consider hiding these columns, although right now I'm keeping all the columns the same because that way, in my views, all my columns are in the same place because I copied the column widths and pasted them here. But the nice thing about this setup is, 2020 is always column J, 2021 is always column K. So if I look here, this is pointing to column J in schedules, and this is in column J. So I don't need to go and check, is column J in schedules the same thing, as long as I've got the same years in the same columns on every sheet. So, here's 2020 in column J here, 2020 in column J here, 2020 in column J here, and here. And so that just makes it a little easier to move around without having to worry about that. Now, something's wrong here, J35. Oh, whoops. Oh, yeah, so sorry, I put in, that's not what's wrong here, but let's just fix that first, because that is also wrong. I put in a space for a formula here and then didn't use it, or a space for a reference, I mean, and didn't use it. But that wasn't what was wrong, so it's J35, and it was copying across. Oh, I just didn't copy it across, okay. So there you go. And then I can, Alt HHN is, HH is home tab and then color, and then N for no fill. So that bit's done, and again, my balance sheet hasn't broken, so now I've just got a little bit less net income, but my net income is flowing into my cash flow and into my retained earnings, so everything stays balanced. So next piece, and the next piece is Capex and depreciation. So opening of each new store will cost the company $75,000 at 2020 prices, increased by 2%. Assume the closing an existing unprofitable store will not bring back any cash to the company, so no disposals, it just goes away, and there will be no reduction in depreciation of existing assets. That's maybe not super realistic, but it certainly makes things simpler. The company does not plan to make any major investment in increasing its capacity, so in other words, that 3,500 store capacity stays the same. Besides investment into new stores, only replacing obsolete equipment, additional capex is 10, then 15, then 5, then 5, then 5, which I assume we will find here. Yes, 10, then 15, then 5, then 5, then 5. Capex per new store we have there, fine. Straight line method of depreciation, fine. Existing fixed assets, 2.5 years. New stores depreciated over 5 years, other capex over 3 years, and depreciation is included as a separate line, not included in the cost of sales or SG&A, which presumably checks out when we come and look over here. Yes, there is depreciation separately. Okay, so next thing, I'm going to, come up here, grab a guess I'll just call it Capex and depreciation schedule. So let's think this through for a second. Probably just want to start with the existing PP&E. So existing fixed assets consist mostly of this remaining useful life. So this basically this opening 184 million I need to depreciate over the next 2.5 years. So let's do opening starting PP&E. I say starting just to distinguish a little from, I'm going to have an opening balance, depreciation, and closing balance. And my closing balance in 2019 I'll get from the balance sheet, which is this number here. And again, I'll make that red, so I'll take this red here. And then my opening here, come from there, carry that across, do that, and then I'm just, similar to the reference I put in here, I'm just going to reference my useful life assumption, which is somewhere up here, I guess. Yes, 2.5 years. And I'll also make that one gray. And then here I'm going to say, so again, start off with the naive version, which will be the opening balance, lock in the column because you're going to be, well, let me just show you. So if I just do it as the previous opening balance or even the current opening balance divided by that, then obviously now I'm not, sorry, I've got to put a negative sign first thing, otherwise it's hopeless, it's going up. But now you can see if I'm depreciating a straight line over 2 years, over 2.5 years, then my first 2 years should be the same. So here now it's referring to the newly reduced opening balance. That's a declining balance method. So what I want is this. So I'm going to lock the column reference in there as well. And then again, you can see that's also naive and incorrect because now I've gone to a negative balance. And so final check here is to say minus the min of this and the opening balance. So in other words, you can never depreciate more than you start off having. And that gets you there. And now I'm going to actually update my number format. So first things first, I can make everything comma and 2 decimal place. But the second thing is where you've got a bunch of zeros like this, I find it quite helpful to come down here and make sure that your zeros. So if you're not used to custom number formats, the first format here, which is just saying, comma and 2 decimal places, is for positive numbers, second one is for negative numbers, and the last one is for 0 with a dash. So put that in, and now you can see that you can sort of see visually, okay, it's gone from here, and this is all empty. So that is simple. Now, got a bit of a decision to make here, which is, you have 5 different years of additional capex, and you have 5 different years from our schedule up here of new stores being added. So you can either basically lay out your depreciation as, whatever, 2020 capex, 2021 capex, 2022 capex, 2023 capex, and so on down, or you can sort of do it all as one row. There are pros and cons. I think the biggest kind of pro of laying it out in this format with it all kind of down here is it's more human readable. So you can say, of the stuff I bought in 2020, X amount of it was depreciated in 2020, X amount in 21, X amount in 22, X amount in 23. Of the stuff I bought in 21, X amount here, X amount here, X amount here, and so on. So that's a kind of plus for human readability, and I think honestly, on balance, that is worth it when you're building a 5-year model. So I will actually do it that way. But if you're building a longer model, like say, for example, you've got a 10 or 20 or 30-year model, or you've got a quarterly model for many years or whatever, if you've got many periods, then this thing that requires a line for each period, if suddenly you've got 40 different periods, that's more of a problem. So again, it very much depends. If you're building an operating model for a project finance kind of thing, then you might easily have 80 periods or something like that, and then you don't want that layout. In this case, it's a little more straightforward. So that's a lot of talk. Let's do some modeling. So let's do new store. Capex and depreciation. I'll just shorten it to C and D. No, I shouldn't shorten it because I'm trying to do this like, at least somewhat like I was doing the exam. So first of all, cost per store, and that is our 0.075 in 2020, which I'll make red, and then cost per store growth, which again, I'm just linking back to the inflation rate, and I'm going to make this whole line italics. Again, it's just a style thing. So that times 1 plus that, and here I'm going to actually increase the decimal place, so I keep the consistent 3 decimal places. This is how many thousands of dollars in the cost per store. So then I guess I'll just call it Capex, total cost of new stores, and that is the cost per store, times the number of stores added, right up here. And again, this time I'm fine with just 2 decimal places. Okay, so I've got my Capex. Now let's talk depreciation. And for this, I'm going to say, well, let's just do transpose of this. Be at least a little bit modern about it, by purchase year. And now, so I'm going to show you a bunch of different ways to do this, starting with a couple of ways to fill out this table, and then, like I said, I'll show you a way to do it without kind of growing the whole thing down like this. But start with the simplest. So 2020 is not actually the best one to start with. Let's start with 2022. So the first thing I'm going to want to say is if this year, lock in the column, is greater than this year, lock in the row, then 0, right? And then for now I'll just say otherwise X. So the first thing I'm going to say is I'm not going to do any depreciating of anything that I haven't bought yet, right? So I'll write a line so you can see that. So in other words, there'll be some depreciation in 2020 for things bought in 2020. There will be no depreciation in 2020 for things that have not yet been bought that year. So that's the very first thing. Now, again, if you had a model with like a shorter period, like a monthly or quarterly model, then you might make a modeling assumption that all Capex happens on the first day or the last day. If your periods are short enough, then it doesn't matter. But in this case, when you've got a yearly model, I think it specifically says it here somewhere. Oh yeah, sorry. Well, this is for the stores, which we're told happen gradually over the year. And I think, yes, for the other Capex, it also says assume Capex is spent evenly over the year. So in other words, on average, a half of this will be depreciated within the first year. So you can think of it as you start off with a balance of 2020 Capex of 0 at the start of the year, end up at 7.5. Your average for the year will be half of that 3.75. So the next thing I'm going to say is if, let's take this again, if that is equal to this, then, and actually, sorry, here I'm just going to, so if you're in the middle of editing a formula and you want to get out without getting a, hey, your formula is wrong error, one simple thing you can do is just put an apostrophe before it, and that just converts it to text. So the reason I'm stopping here is because I want to go and get my, I want to go and get a link for my depreciation useful life, which is somewhere, it's up here. So right now I'm doing new stores, they're good for 5 years. So I'll just put it here, useful life. Boom. Sorry, I'll say useful life years. And again, lots of different style options, but I'm just going to do it that way. So now I'm going to say, if I'm in that year, sorry, so now I'll get rid of the apostrophe again because then it goes back to highlighting cells and other useful things. So if I'm in the year of the purchase, then I want this, and I'll lock in the row because I'm going to copy this formula down, divided by this, which I will lock in both row and column because for all the all the cells in this whole table are going to reference that one same cell, divided by that, divided by 2, and otherwise, so I've figured out what happens if I'm before the purchase, I figured out what happens if I'm in the year of the purchase, and then otherwise I'm, well actually, right, again, I'll start off naive and say just otherwise give me a full year of depreciation, and then close out the if. So here I've got exactly 1/10 of that, which makes sense because it is 1/5 of half of this, so it comes out to 1/10. So if I copy down and across, it's all right. Let's go and get my number format where I had my zeros looking better. Sorry, Alt EST to paste the format. That's better. And oh, sorry, beg your pardon. So a couple of mistakes there. So first of all, I have it pointing up to here, but now I'm saying in 21 point to my 2021 spend, when I should be, this whole row is what happens to 2020. So what I'm going to do is I'm going to put in Capex $million, oops, $million, and I'm going to transpose that as well. And that way I have it in the right row where I need to reference it. And again, I'll gray that out. So now instead of pointing to this one, I mean, again, for the one in this case here, you're in the current year, so it doesn't matter whether you refer up or to the side, but just to keep consistent, I'll refer this one here to the side and also refer this one here to the side. So that was one mistake to fix, which wasn't actually the mistake that I meant to show you, but sometimes I make other mistakes. It's always good to just eyeball these things. The first thing you should see is straight line depreciation. The first year is different because you're only depreciating, you know, an average of half of it, but every other year should be the same amount. Every other year here, every other year here, every other year here. And you can also just do a check to say, you know, this over that. Or actually, if you do it the other way around, you should get a whole number. So that over that gives you the 5, the 5, the 5, and so on. So that's all checking out. Now, because you're only doing a 5-year model and you've got a 5-year useful life, you could just leave it like that. But if you were to you know, extend this model further forward, you'd need to extend up here as well. Then that's going to start to misbehave. So, you know, suppose that we sorry, let's just that +1. So now you're saying, okay, so I've got 0.75, then 1.5, Now I've depreciated 11 million of something I only spent 7.5 million on. So what you have to do is limit it. So how are we going to do that? We're going to say a little bit like what we did up here, where you say you can't depreciate more than there is to start with. So in this case, what there is to start with is the initial investment minus everything that's been depreciated in previous years. So what's that going to say? It's going to say min of a full year of depreciation versus this minus sum, and sorry, this I need to lock in the column again, and the sum of that, and lock in the starting column. So I'm going to lock in the $I on the start here, but not the I on the end. That means that will expand and keep coming across after me. One more closing bracket there. So now first let's just check it's working, and it is. So I depreciate the full 7.5 million, and then I don't depreciate it anymore, so that's good. Now I'll just get rid of these extra columns. The second thing I want to do, because I'm now pointing to an empty cell, again, your preferred style may differ, but it's good to have some indication that that is, you know, that is a cell in use. So it would not be a good idea, for example, to put in a sum here as a check to make sure that you were depreciating the full amount, or that it was less than that, or something like that. Because if you put in something here, the rest of this is going to behave in a way you don't expect. So just as a reminder to your future self, if you're referencing a blank cell, sorry, I've got to copy that down and across. If you're referencing a blank cell, just format it in some way. And then now that we've done that, it should be pretty easy to do, sorry, one more thing. Not quite one more thing, many more things, but let me just get the sign right. So this should be negative, and this should be negative, and then this should become positive, and hopefully then all the numbers stay the same with the signs flip, and they do. Good. So then that's my new store, and then my other Capex and depreciation. Now, quick check. We're given numbers. Are they nominal or real? All nominal numbers with inflation already included. Okay, fine. So my Capex goes here, and that's just going to point to that assumptions tab. Copy across. I'll give it 2 decimal places, and then I'm just going to copy this whole section. I'll obviously need to check for adjustments, but for now let's just paste all of that in below. I'll need to change my useful life reference to point up to this 3 years, and then I'll probably need to change some reference that locks in a row or a column. So first things first, pull that down. I need to do that a couple of times because there's a couple of references to it. Oh, and sorry, this is also not pointing to the right place. So let's just copy that. Go there. And now we're getting there, but we're not quite working. So here am I still pointing to the 5 somewhere? No. So I should be taking a third. Oh, sorry. Okay, yeah. So I updated my reference from the 5 to the 3 here, but I didn't copy down and across. So I do that, and now, yes, everything is lasting 3 years. So I've got 10 million spent, a third of that per year. So I've got 2 years where I spend a full third of that, and a year at the start and the end where I spend a half of that. So that's all checking out. So that's good. So then, what am I going to want? I'm going to want my my closing balance. Well, my total depreciation. Right align that to match those, and then my closing balance. And same thing here. We'll do total and closing balance. Balance. So total just sums that, copy across. Same thing here. And again, I'll just put in a line there and maybe bold it, make it a little easier. Again, human readability is important. And then again, I'll do this. So my closing balance is going to be my previous opening balance plus new Capex less new depreciation. Carry that across. And I'll put the same thing up here. And is that still pointing to the right Capex cell? It is, so that all works. And then finally, I just need my total PP&E, total closing, PP&E, and my total depreciation. I can't spell. Depreciation. All right, I'm actually going to put these back over here so they line up with this section rather than with the subsections of that. So my total depreciation is going to be back up to here for, that's my opening depreciation plus depreciation on new stores plus depreciation on new everything else. And I don't know why it does that with the format. I don't want to copy that one, I want to copy this one because I don't want it to be bold. Oops, sorry. I'm just going to Alt-ESW to put back the column width to where it was. That's my total depreciation and my closing PP&E. Let's go up again. It's the closing balance of the starting stuff, plus the closing balance of new stores, plus the closing balance of everything else. And again, with the weird format, I don't know why it's doing that. And copy that across. Okay, now I said I was going to show you another way to do this, which I just realized I haven't done yet. But first, what do I want to do first? Yeah, first let's plug this in and see if we can get everything to behave. So first we'll come to the income statement and link up my depreciation. That's the only thing that has to go into the income statement. Then we'll come over here. Oops. We'll add back the depreciation. Oh, sorry, beg your pardon. So I've got a minus going on here. So that's a little odd, but fine. Let's just keep consistent, and we'll format that with 2 decimal places. So, and it's a good kind of sense check that, you know, my depreciation is roughly the same order of magnitude before and after. It's actually falling off quite a bit in the later years, but okay, maybe they were in a growth period and that's coming to an end. But you just don't want a big discontinuity here would be a little bit of a red flag. Anyway, so now here I point to that. Now you can see my balance sheet is not balancing anymore, but let's hold on because there's a few other pieces to pull in here. Capex, I need to, oh yeah, sorry, I should have total Capex here as well. So let's do that, total Capex. This one's, when you've got the big red setup as I do here, it's always a little scary where you have something where you have to add in a few pieces where you're like, I really hope that it all ties out. Sorry, that wasn't. Talking and modeling at the same time, risky. Anyway, really hoping that it all ties out at the end. Let's see. So, cash flow. I'm going to put minus sign because that's negative cash flow. And that still leaves me out of balance, but that's fine. That's everything that hits the cash flow statement. And now my net PP&E, back to the same schedule. There, copy it across. Oh, hooray! So now I'm back in balance. So again, this is a case in point that, you know, you think about the moving pieces here, PP&E, the Capex, the depreciation, all kind of tying out together. Multiply that by all the other schedules that we still have to do, and you can see this is this problem could get a lot to wrap your head around if you had to, you know, piece it all together in one go and make sure you didn't miss anything. Whereas like this, you know, if this had stayed red, it wouldn't be that, you know, there wouldn't be that many places to look to figure out what was going wrong. We'd go down, see what was happening to the balance. You know, basically you can kind of debug when you're doing just one thing at a time. But in this case, it worked, so we don't need to debug, so that's fine. So let me just quickly show you another way of getting straight to this line without having to break out these lines, which would be more useful if you had more periods. So we'll do depreciation alt formula. And again, I'll just do the same, highlight this the same way as I did my picky average, I guess. Where did I put it? Here it is. Okay, so now this again there's a kind of swing and a roundabout here, which is in a model where you had many more periods, it would be much more typical to assume that Capex was, you know, always on the first day or on the last day of the period, because, you know, you're looking at monthly or quarterly, and so you don't need to worry so much about, you know, was it this or that time in the year. And in that case, this formula I'm about to show you actually works a lot more neatly. But having said that, you know, it still works. So what am I depreciating in this year? Well, I'm depreciating you know, 1/6 of whatever I bought in this year, or let's go to a year that's a little more complicated. Let's go this year. I'm depreciating 1/6 of what I bought in 2023, 1/3 of what I bought in the 2 years before that, and 1/6 of what I bought in the year before that. So how might I express that? I say sum ifs, my Capex, and I'll lock in the columns where this, sorry, I'm just going to scroll up so you're not behind my face. Sorry, and this I'll lock in both the rows and columns, where that is, let's say, less than the current year. And where it's greater than the current year minus the useful life. So that's sorry, lock in row and column there. So that's how much, what that sum ifs is telling me is how much in total did I spend in the years that I am fully depreciating this year. So before the current year, but after 3 years before. So in other words, if something is 3 years old, I'm only half depreciating it this year. If I bought it this year, I'm half depreciating it. Anything in between, I'm doing a full 1/3 of that. So the first piece is going to be minus that over 3. And then, sorry, let's do that. And so that corresponds to this 5 and this minus 1, this 5 and this 1.67 gives you that 6.67. So that's the bit in the middle, and then you can see if you extended the useful life to 5 years, this sorry, what am I doing? Yeah, sorry, then this would go further back. Is it? I don't know why that's extended the useful life to 5 years. Because only 6.5. I'm confused. Oh, sorry. Yeah, okay. I'm being an idiot. I've put in divided by 3. I should have put in divided by linked to that cell. Very important. So now if I change the useful life to 5 years, these 3 cells are the ones that are being fully depreciated, and that matches up to that 6 million there. And then obviously if I make the useful life longer, shorter, whatever, the point is that I don't need all these rows. So now that's all the sort of piece in the middle. Then the depreciation for this year is kind of the simplest one. So it's just that, lock in the row, current year depreciation divided by useful life, lock in, divided by 3. So that gets you to minus 7.22, which is the sum of, oops, what's going on here? Oh, sorry, again, I've done a 3. Sorry, that's divided by 2. Okay, so that gets you to the 7.5, which corresponds to, so the middle period we've already done, and the new bit we've added is this, and then the last thing we just need to add is the half-year depreciation from 3 years ago, and that's just going to be a variant on this guy here. So let's just copy this. So SUMIFs where, just drop one of these because I only need one condition, where the year is not greater than or less than, but equal to current year minus the useful life, divide that by the useful life and divide by 2. And so that gives you the 9.17 that matches that, and then if we copy it to the other years, those all match up. So now you can see, so that you can, you can kind of see what I mean when I said that in a world where you don't need to worry about a separate formula for the current year and a separate formula for exactly the useful life ago, then you can do it all as just one SUMIFs. So in other words, if the depreciation is always always kicks in the year you buy it, or always kicks in starting the next year, then there's just one SUMIFs, and this formula becomes a lot simpler. But if you have the 2 sort of edge years to deal with, then you can just do it by, here's the current year, and then here's 3 years ago, 5 years ago, whatever. And again, you can see, quickly check, if I put in 5 there, this still matches out every year. So that's the alternate way to do that. So we're probably more than halfway there in terms of the actual building, and then maybe a little bit more in terms of tidying up, but I think I'm going to have to say that's enough for today. So I'll hopefully be back with another one before too long. Thanks for watching.